This video is brought to you by Incogni. Shortly after becoming Chancellor of the Exchequer, Rachel Reeves claimed she'd discovered a £22 billion black hole in the public finances, which is essentially the amount that public spending is predicted to go over budget this year. Now, no politician likes fiscal black holes, but what makes things so difficult for Reeves here is that her campaign pledges have basically ruled out all the obvious solutions, like more borrowing, spending, cuts, or increases on big taxes. So in this video, we're going to explain the situation Rachel Reeves currently is in, and whether she might be able to close the fiscal black hole without breaking any of her promises. Before we start, if you haven't already, please consider subscribing and ringing the bell to stay in the loop and be notified when we release new videos. Broadly speaking, there are three ways to fill this metaphorical black hole: more borrowing, less spending, or more taxes. Unfortunately for her, Reeves has basically ruled out all three. When it comes to borrowing, Reeves has committed to two so-called fiscal rules. The first fiscal rule is that the budget must move into balance, which essentially means that the Chancellor is going to have to close the black hole. And the second is that debt must be falling as a proportion of GDP by the fifth year of the forecast, which essentially means that she can't close the black hole by increasing borrowing. When it comes to spending cuts, Reeves has also promised that there won't be a return to austerity, which, under most definitions of austerity, rules out massive spending cuts. And when it comes to tax rises, Reeves has again tied her hands, having promised during the campaign not to raise corporation tax, income tax, national insurance, VAT, or any taxes on, quote, working people. Nonetheless, Reeves will probably have to raise taxes if she wants to fix the black hole. But the issue here is that the taxes that Reeves has ruled out account for an absolutely massive proportion of the UK's tax receipts. Income tax, national insurance, VAT, and corporation tax accounts for roughly 75% of revenue from tax. If we also want to assume that Reeves won't raise council tax and air passenger duty, which could plausibly be considered taxes on working people, this rises to about 80%. In fact, once we take into account other taxes that probably can't be raised, as they're already comparatively high, such as stamp duty and bank taxes, and taxes that are too politically toxic, such as alcohol duty, we're left with only really about £100 billion worth of taxes. So how can Reeves raise £22 billion from just these remaining taxes? Well, there are effectively two main ways being speculated. The first is by sidelining taxes and instead going for pensions, and the second is by significantly adjusting capital gains tax, or CGT. Let's have a look at these approaches in turn, starting with pensions. Essentially, as things stand, employees can get tax relief on their private pensions worth up to 100% of their annual earnings, up to £60,000. In practice, this means that if they've paid national insurance or income tax on pensions contributions, they can get this refunded. However, there are some politically feasible changes here that could bring in a relatively large amount of money each year without necessarily hitting lower income earners. The way to do this would be to change how the tax rebate works. As things stand, if you're a higher earner on a 45% marginal rate of income tax, you can get 45% tax relief on your pension contributions. One way of bringing money in is to limit relief to, say, 20% or 30%. The effect here would be that those on a lower marginal income tax rate, as a result of their lower income, would still effectively get full tax relief on their pension contributions. It would only be those on a higher marginal tax rate that would begin to pay tax on their contributions. The IFS predicts that capping income tax relief at 30% would raise £3 billion, and capping income tax relief at 20% would raise about £15 billion. Now, it's worth noting here that money put into a pension is generally not taxed, whereas money taken out of a pension is, and this policy would violate this principle. Nonetheless, this is one way in which Reeves could adjust the current pension arrangement. Another way of raising money from pensions is by introducing national insurance on employer pension contributions. Right now, national insurance isn't levied on pension contributions at all, and this costs the Exchequer in the region of £24 billion a year. There are no suggestions that Reeves will go all the way and introduce national insurance on all pension contributions, but there are some suggestions that she could, instead, introduce it on specifically employer contributions to raise as much as £16 billion. The advantage here is that it would be businesses, not people, that would be expected to pay this. This makes it politically easier to sell. However, it also has the potential to clash with Reeves's proposed plan to try and increase growth. So, moving on to Reeves's second potential target, capital gains tax, or CGT. Now, CGT is effectively tax paid on the profits from the sale of an asset that is increased in value, for example, selling stocks that aren't in ISAs. There are two main things to consider here, though, when discussing raising CGT. The first is that CGT is complicated, and the amount paid really depends on the type of asset being sold and the rates of other taxes. In raising CGT, some would argue that it should also be simplified. The second thing to consider is that in many cases, CGT is actually a lot lower than income tax, something that people often point out as being unfair. In fact, so much so that both the Greens and the Liberal Democrats promised to equalise CGT and income tax in their manifesto this year. In theory then, simplifying and increasing the tax on CGT sounds like a good idea. It would only affect the profits of those selling their assets, and would seemingly make the tax system that bit fairer. There are, though, two main issues. Firstly, CGT just doesn't account for that much tax revenue. As we showed earlier, the UK government takes in about £1 trillion in taxes each year, and CGT receipts account for only £15 billion of it in total. So there'd need to be a really big change for the Exchequer to significantly increase the amount they receive. And, well, the second issue is that if you do raise this significantly, you discourage people from selling assets, encouraging them to either sell them before the rates go up or hold on to them until the rates go down. In fact, it's this that led HMRC to claim that putting CGT up would cost about £3 billion in lost tax, rather than increase the amount the Exchequer receives by £5 billion, as the Lib Dems have suggested. Now, that's not to say that there isn't a way of increasing CGT and increasing the tax receipts on it. It's just that any rises cannot be too steep, otherwise it'll discourage asset sales, which means equalising CGT alone is unlikely to get you close to £22 billion. All in all, it's hard to see how the Chancellor could raise £22 billion on these taxes alone, which means she'll probably have to either cut spending in places, which is apparently being considered, or fudge her fiscal rules to allow for more borrowing. Now, as we've demonstrated in this video, there's a huge amount of uncertainty in the world of politics and current affairs, often with few easy solutions. Unfortunately, this can be the case online too. There are all kinds of bad actors out there that want to try and use you to make a quick buck. Take, for instance, data brokers. They collect, aggregate, and sell your personal information, including names, aliases, social security numbers, login credentials, home addresses, location history, online activity, and more to the highest bidder. This can result in everything from spam to identity theft. Luckily for you, though, there is a solution: Incogni. They work on your behalf to request your personal data removal. They also deal with any objections, and to make sure that your personal information isn't shared by the brokers again, conduct repeated removal requests. And with their family and friends plan, they'll even do this for you and up to 3 of, well, your friends and family. So, create an account with our link in the description, grant Incogni the ability to work on your behalf, and sit back as they make you safer. Plus, by using our link, you'll get an exclusive 60% off an annual Incogni plan. Thanks for checking it out, and thanks to Incogni for sponsoring this video.